Welcoming you for the P2P interview question and answer preparation. The first question is going to be the golden rules of accounting. So there are three types of account: personal account, real account, and nominal account. When it is a personal account, it is balance sheet related, persons related. So debit the receiver and credit the giver. So receiver usually be the customer and credit the giver. When we vendor sell goods to us, they are the giver, so we are crediting them. And this will be vice versa. When they make the payment, we will debit the vendor because they are receiving the money from us, and when the customer pay us, credit the giver because they are giving us back, right? For the sales that we made, they are making the payment. At that time we will credit the customer. Real account is asset related. Debit what comes in. Whenever we buy an asset, we have to debit it, and credit what goes out. Whenever there is a reduction in the value of asset, for example, cash is going out, at that time you will credit cash. Okay. And the next account is nominal account, P&L and trading account related. So this is very straightforward and simple. We know that we always debit all expenses and losses and credit all incomes and gains. Second question is about what is P2P. When we call P2P, what do we mean by that? P2P is procurement to payment. It is a process of obtaining raw material, consumables and services and or assets from external suppliers to our business and paying them for the goods and services that we receive. So basically it is procurement and payment. Third question is explain P2P cycle. So procurement cycle starts with the requirement planning. The company has to plan their requirement and they will request for quotation from the vendors, and then once the vendors have given us the quotations, they will validate it and they will create a purchase order to the vendor, and then vendor will supply goods to us, so we will receive goods, and then we prepare the goods receipt in the system. And then what happens, we will create the payment for the invoice that we receive from the vendor, and then we complete the payment, and then finally we do the reporting for the P2P. Who are vendors and requirements for vendor setup is the next question. So vendors and suppliers are basically those who provide us raw materials, consumables or services for our business, right? And what are the requirements to do a vendor setup? Whenever we receive a new vendor, we have to get all this information to record in our systems, right? So vendor name, vendor's tax ID, types of taxes and rates applicable for them, and their addresses, dispatch address, dispatch site, payment address, help desk contact detail. This is vendor's help desk contact detail, bank account detail, payment terms, with what payment term we are going to create them, type of goods and services that he is authorized to supply to us. The next question is going to be who considered as critical vendors, what is the special treatment we do for them, right? Vendors whose service stoppage will stop our day-to-day operations are considered as critical vendors. If they are going to stop their service, then our operation will interrupt, right? Those kind of vendors are called critical vendors. For example, electricity provider, if they are going to shut down their electricity supply, then our operations will not happen. So that kind of vendors are listed as critical vendor in every organization, right? So for these vendors, the payment should be made on time without fail, and we need to pay special attention on processing and releasing their payment, and each company maintains a list of their own critical vendors. Example of such critical vendors, as I said, electricity, water, telephone, transportation, and especially government invoices like tax payment, duty payment, all that are called critical. The next question is explain one-time vendor. Vendors with whom we conduct business once or very rarely, right? Such kind of vendors are called one-time vendor. A special vendor master record is created for one-time vendors. So there will be only one vendor account number for them. But when we create an invoice for them, there will be an automatic trigger of vendor master setup from that vendor ID, where we will enter the name, address and the bank detail of such one-time vendor to execute the payment. The next question is explain pre-purchase stage. What do we do before purchase? First we have to identify the vendor. First stage is vendor identification, and then we negotiate and vendor evaluation, meaning we always negotiate with number of vendors and we will evaluate which vendor is going to give us a beneficial delivery, right? So that evaluation happens, and then we do a selection from those evaluation. We would have evaluated 10 vendors, and then we select one or two vendors from them, and then we do a vendor setup to do a further business with them. Stages in purchase, right? So there are two stages. One is when they raise a purchase requisition. So purchase requisition is basically raised within the company. It is raised by the production team to the procurement team of the same organization, right? Purchase order is raised to the vendors, from the company to the vendors. These are the two stages in purchase. The next question is to explain post-purchase stage. After purchase, what happens? So we receive goods from vendors, and then we receive invoice and we handle it. We post it in the system. That is called invoice processing and invoice query resolution. Sometimes vendor queries about their invoice, about this payment status, etc. That we will do, and then finally we do the payment processing. The next question is stages in the payment processing. What are the stages? First, we do the payment proposal. So basically, when we do the payment proposal, we send that proposal to the treasury or the head of finance for approval. Basically, in here they will see how much they are going to pay for this week or for that particular timeline, and they will approve for payment, after which payment proposal happens, and then we release the payment and we do the clearing of payments in the vendor books. This question says about other activities in P2P cycle. Apart from invoice processing and the payments, what are the other activities we do in the P2P, right? We do vendor account reconciliation. Whenever we receive a statement from the vendor, we will reconcile the line items of the statement with our books to understand what is missing. And then we do vendor help desk query handling, where vendors queries are handled through this help desk. And finally we do month-end processing. We'll see all these in detail in the coming sessions. This is the question about control checks for vendor setup. So always we check for the duplicates. We check if the vendor is already created or not. Check for approval for the setup. So whenever there is a request received from our client team, we'll have to check if that is approved by the appropriate person. Check whether the information has been provided by the vendor directly. So that validation we will have to do. Verify the bank account details of the vendor with the supporting provided by the vendor. Okay. So what happens if the supporting or the approval is not available? Then you will have to hold the vendor setup. You will have to ask for the missing information from the client. If the missing information is not supplied, maybe we can escalate the matter to the client, who is the higher authority. This is the question, like process metrics reported and measured in the P2P. So what are the metrics that we usually measure? So for invoice processing and payment and help desk, we do measure two metrics. One is accuracy and the other one is turnaround time. When we talk about accuracy, it is number of transactions without errors reported or processed in the month. When we talk about turnaround time, it is the processed within the agreed timeline. For example, if the invoice processing time is agreed for within 3 days, then we have to ensure that we process all the invoices within 3 days. And what is the metric that is there in VMD? Usually it is average time taken to set up a new vendor. Same way they measure average time to service a modification request. Next question is, what is invoice? Invoice is a statement from the vendor requesting payment for the goods and services supplied to us. So invoices can be classified as two different categories based on the document. It can be electronic invoice, which is received through email, or paper invoice, which is directly received as a paper copy. Based on the type of invoice, it can be classified as PO based invoice or non PO based invoice. Next question, what are the details required on the invoice? So legal entity name and address to which invoice is raised. Basically it is our address. When the vendor raise, they have to mention our legal entity and address properly, and shipping address if different from our billing address. Sometimes we give some other shipping address at the time of raising purchase order. In such case they have to mention the shipping address very clearly. Item and service description and quantity have to be mentioned in the invoice. Amount and currency should be there. Payment terms which is agreed with the vendor should be mentioned. VAT amount, the amount, I mean the indirect tax that is applicable for the respective countries should be mentioned in the invoice. PO number, in case it is a purchase order invoice, then PO number is a mandatory requirement. And if it is a non-PO invoice, they should mention GL code and cost center. Some of them don't mention GL code because it is taken care by the finance department, but cost center is something very very necessary to book the invoice to the respective department. Buyer name again is a mandatory requirement for non-PO invoice. Buyer is the one who contacted the vendor for the service, so this buyer has to be there mentioned on the invoice so that we can send the invoice to them for validating the service. Next question is, what if the PO and the invoice detail does not match? What do we do? So we contact the PO requisitioner for clarification and the correction. So we usually see two types of mismatch. One is price mismatch and the other one is quantity mismatch. We call it as variance also. So price of the item stated on the invoice and the PO does not match when there is a price variance, and when there is a quantity variance, the quantity of the items does not match between invoice and the purchase order. There could be oversupply or undersupply. In these scenarios we have to contact the PO requisitioner for correction, or if they are asking us to reject the invoice back to the vendor, we can very well reject it. Next question is about non-PO invoice processing. Maybe they will ask you to share some points about non-PO invoice processing. So non-PO invoice basically used for service related when the entities go for non-PO processing. Proof of purchase or receipt of goods is not readily available like purchase order. Hence, buyer validation should be done. So buyer should validate the service provided, and the cost center GL account codes needs to be determined prior to processing. This should be either provided by the vendor or should be processed by the AP processor based on buyer's advice. Invoice may not be numbered. Some cases where, for example, for telephone bills and all, we don't get invoice number, for in which we will have account number. So this is one of challenge. So we always use account number followed by month to differentiate, or to be unique we use the month for the respective account numbers. And then vendor may not have been set up for non-PO invoices, whereas for PO invoice vendor will be readily available, because without vendor creation they cannot create the purchase order. Okay. Next question is controls for non-PO based invoices. Since there is no purchase order, what are the controls we follow? So we have to check whether all required information is available in the invoice, like invoice number, amount, payment date, cost center and GL codes, right? And then check whether the vendor exists in the master database. Check for duplication if the invoice is already processed in the prior period. Send the invoice for buyer validation for service received. Seek approval from the cost center manager for the cost. This is the financial approval. Next question is direct expenses. Direct expenses are usually cost of goods sold. So cost of goods sold are the expenses directly related to the creation of a product or service. Example, cost of material, direct labor or factory rent kind of expenses which are directly related to manufacturing of a product is called direct expense. When it is indirect expense, these are expenses that cannot be assigned directly to any activity or a product, since these are completely incurred while operating a business or part of a business. For example, business permit, which is not directly related to the production of product, rent of office, office expenses, telephone bills, depreciation, audit, legal fees, and all are called indirect expenses. Basically, direct expenses comes in the trading account and indirect expenses comes in the P&L account. Next question is, when do we reject invoices? What are the instances we reject invoices back to the vendors? Missing an incorrect purchase order number, missing buyer or coding information in case of non-PO invoice. Approver does not approve the invoice and has disagreement with the amount invoiced. There is a dispute, then the approver does not approve. At that time we reject. Discounts not passed on or incorrect price stated on the invoice are some of the examples. Invoice amount exceeds the threshold limit in case of non-PO based invoices, and incorrect legal entity billed. Our entity name is incorrectly mentioned, then we reject the invoice. Incorrect currency billed, for example, instead of USD they billed us in euro, then for whatever currency they are going to bill us apart from what is agreed, then we will reject the invoice. Next question is, what is direct debit payment? So some vendors are authorized to collect payments from our bank directly for the service that they are rendering to us. Example, utility bills, so that get directly paid from our bank. So vendor will submit the invoice, and then what we do, we offset the invoice with the payment that is already made from our bank, right? There will be a payment entry already available. So once the invoice is received from the vendor, we process it and offset it with the payment that is made. Hence we need to block these invoices of the direct debit vendors. So whenever the procurement says that this particular vendor is a direct debit vendor, we should always block the invoices of those vendors, because payments are directly going from our bank. We have to just offset the invoice with the payment that is already made. So we have to be very careful while processing the direct debit vendor invoices. Next question is, what is debit note and credit note? So debit note, when a buyer is returning goods, a debit note is an intimation to the seller of the amount quantity being returned and requesting return of money. So usually buyer raise a debit note. When a seller receives goods, return goods from the buyer, he prepares and sells the credit note as an information to the buyer showing that the money for the related goods is being returned in the form of credit note. This credit note will be offset with the future payments. Next question is credit note processing. So a credit note is issued by the vendor to return the money that has been overpaid or the return of goods or discount allowed. It comes in the form like an invoice itself. It can be identified from the caption of the document. The document, like an invoice that we receive, the caption will be credit note, credit memo, or credit invoice. By this we can identify that these are credits. Care needs to be taken to process those credit notes, because sometimes people used to process it as an invoice and pay again. So whenever we receive a credit note, it has to be processed as credit. Next question is value added tax, VAT, or goods and service tax, GST. Both of these are indirect taxes, right? Goods and service tax are indirect tax placed on a product whenever value is added at each stage of production or distribution. There are two types of tax, we call it output VAT and input VAT. We can call it output tax or input tax. When do we call output tax? When there is a tax added that is calculated and charged on the sale of goods or services from our business. This must be calculated on sale to other business and consumers. Input tax is the value added tax that is added to the price when the goods and services are purchased. When we make a purchase, if there is a tax, it is an input tax. When we make a sale, if there is a tax in the bill that is sent to the customers, it is a output tax. This is the difference between input and output tax. So next question is, explain payment processing. So processed invoices needs to be paid as per the due date. Payment processor runs the batch jobs on the processed invoices depending on the mode of payment indicated against the vendor during the vendor master setup and the bank detail accounts. Invoices are paid. The payment is routed through various means: check, automated clearinghouse, or wire transfer. If any advance payment was made to the vendor already, then the advances are to be adjusted against these payments. Okay, whenever there is an advance payment that is open in the vendor books, it has to be offset with the open invoices and then paid. Next question is payment control checks. What are the checks for the payment? We need to ensure that the payments are not duplicated. Every company has its own tool to find out duplicates. So we'll have to run that tool and get the report and do the duplicate check. Ensure large payments, amounts higher than a certain threshold limit, match with the corresponding invoice. So for example, some companies do audit for greater than 10,000 local currency, right? So that audit needs to be done before payment, and then payment proposal should be sent to treasury for review and approval. After treasury's review and approval, it has to be sent to the final approver for approval and disbursement. Next question is to explain the payment block and reporting. Review invoices which are on block. Okay, so block is usually at invoice level or vendor level. We can block certain number of invoice, or we can block the vendor as a whole. Okay, there are different scenarios for which we block the payment. Whenever there is a debit balance, which is the balance to be recovered from the vendor, we used to block that particular vendor for payment. If the systems like SAP always have a system control to block such vendors from making payment. And then vendor confirmation to hold the payment. Vendor is asking you to hold the payment, then you can block at that time. And client confirmation to hold the payment. When our client advises us to hold the payment, we can hold it. And whenever there is a mismatch or missing bank details, then we will block the invoice. Payment block due to missing approval from client. When there is an approval pending from invoice, in such cases we can block the invoice. Example, price and quantity variance. If it is pending for approval, then we can block the invoice. Tracking for all payment blocks needs to be done before releasing the payment to ensure the timely payment. If we just leave the blocked cases as it is, then the payment will get delayed, and which will lead to escalation also. So we have to do a regular chase up on those blocked cases to unblock them and make the payment on time. Next question is explain travel and expense process. So basically expense claims for employees who travel for business purpose or make business related expenses like airfare, taxi fare, and accommodation charges and food charges are claimed by the employees, right? This will be paid by the payments team. An employee can pay for their expense through the card that is given to them, for example Amex card, and through cash also they can pay and then claim the same from the company. Any official expenses can be claimed through travel and expense process. Claims needs to be processed diligently so that the employees can be reimbursed on time as per the company's policy. Personal expenses cannot be claimed, and these are scanned under audit check. Any deviation will lead to claims rejection or partial payment to the employees. There needs to be a check for authenticity of the receipts. So these acts as a necessary proof to process those claims and disperse the payment. Advance payment for any employee needs to be adjusted at the time of disbursement, at the time of final settlement to the employee. So this is the travel and expense process. Next question is stages in travel and expense claim processing. So first, approval of T&E request prior to incurring expense. Any employee before incurring expense have to get the approval from their manager. And then the submission of claims by the employee. After the expense is incurred, they will have to submit the claim. Approval of claim by employee supervisor again. And then verification of claims by the T&E processor. And then payment of claims by the payment processor. And finally, employee helped us to address any employee claim related queries. They can always raise any query related to their claims. The next question is explain vendor account reconciliation. So vendor account reconciliation is a process of comparing two sets of accounting information. Check our vendor account in ERP with the vendor statement received from them. Okay, what are the reasons for differences? So transactions recorded and the respective balance do not match. So sometimes we would have entered or processed any invoice with the incorrect value, because of which sometimes the balance do not match. That has to be identified. Payment was made to the vendor but was not recorded in his book. We would have made the payment, but it is missing in his book. So, and then goods were not received or were returned in damaged condition, hence invoice was rejected or returned, but which is not reflecting in the vendor books. Discount was not passed on to the eligible customers, not recorded in vendor books. The late payment or the other penalties were not paid by the customer to vendors but reflecting in the vendor statement. So these are the various scenarios in which there will be a discrepancy between vendor account in ERP and the vendor statement. Next question is month-end processing in P2P. So what are the other activities they do during the month-end close in P2P? First one is accrual reporting. So we provide the detail of unposted invoices to record to report team for processing accrual journal. This is basically to register the value of all the unposted invoices in the books before closing. And then IC invoice posting, post pending unposted intercompany invoices during the month end close before the books close. And then intercompany payment, so make all payments to intercompany vendors if they are due before the month end close. These are the critical tasks that the P2P team does during the month end close time. Next question is about journal entries in P2P. What are the key journals that we do in P2P? So for purchase order, at the time of creation of requisition and at the time of creation of purchase orders, there is no journal entry that is passed. So whenever there is a receipt of inventory, goods receipt, right, at that time material account, the goods account is debited and GRIR account is credited. GRIR account is a control account. So when we receive an invoice from the vendor, we instead of since we have already debited the goods, this time to offset this GRIR account, we debit. Here it was credited, now we debit the GRIR account and credit the supplier account. Okay, when the supplier payment is due, when we have to pay the amount to the supplier, we again debit the supplier and credit the bank clearing account. Again, this bank clearing account is a control account and to clear this control account, the bank this bank clearing account is debited and the respective bank account from which the payment has gone is already a credit. And when we receive a refund from suppliers, bank clearing account is a debit and supplier account is a credit. And when the credit note is booked, supplier account usually is credit at the time of invoice, but when it is a credit note, the supplier account is debited and the respective expense or material account is credited. It is reversed, right? It is a reversal of this entry. And AP accrual entry, when there is an accrual to be made during the month end close, accrued expense account is a debit, it's a leg in P&L, and to accrual account is a credit in balance sheet. Okay, it is a temporary liability account that is being posted at the time of month end close. The next month beginning, this entry will be reversed. It's a temporary journal entry that is posted for unposted vendor invoice transactions. And these are the journal entries posted when it is a PO related. So GRIR account comes when it is a PO related journal posting. When we move on to the non-PO invoice journals, entries are lesser. So directly the expense account is a debit and to supplier is a credit. And when the payment is made to the supplier, supplier is a debit and bank clearing account is a credit. And when clearing from bank ledger, bank clearing account is a debit and bank account is a credit. With this question, we are coming to a conclusion. and we have come to the end of the session. So if you have any further questions on the P2P, feel free to type it in the comments. I'll try to cover it in our next session. Thank you so much.